Hello traders. So in this lesson, we're going to learn how to trade safely and efficiently. What we're going to learn here is how to buy low and sell high, minimize risk and maximize reward, and entry confirmations to improve your probabilities. So our main objective here is to buy low and sell high. We're looking to buy or sell price in reference to the ranges high and low. The purpose of this is to limit possibilities and potential outcomes. So what we're doing here is we're limiting price to 3 potential outcomes: rejection, failure, and liquidity sweep. Risk mitigation is huge as well, as your risk exposure is much smaller due to limited possible outcomes. So what we're going to do is we're going to be purchasing price at the bottom of the range and selling price at the top of the range. And not only the benefits of your risk to reward with your stop loss being a lot tighter, we're also looking at it from a outcome limitation standpoint. So if you are purchasing price at the bottom of your range, the outcomes are limited. But if you are purchasing price in the middle of the range, price could always come back to the extreme. Price could always form a structure, stop hunt, and still decide to come back to the extreme before completely expanding. And we're trying to avoid this multi-step scenario. This is why we are going to be purchasing price at the bottom of the range, and we're going to be selling price at the top of the range. To buy low and sell high successfully in the market, you need to determine whether you are a buyer or a seller. And there's multiple ways you can determine this. And in this lesson, we're going to cover the easiest two. Well, the easiest is looking at basic market structure and following the trend and looking at swings for context. So you're looking at your swing high and swing low and seeing if the market is making higher lows and lower lows, or if the market is making higher highs and higher lows. In a bullish trend, you're only looking for buys. And in a bearish trend, you're only looking for sells. Before you proceed, please make sure you like the video and subscribe to the channel, and make sure you have your notifications on as well so you can keep up with the latest content. So again, the easiest way to determine whether you are a buyer or a seller is to simply look at the swings. And the easy trick is you could always zoom out to get a better view. And as you can see here, price is making lower lows and lower highs, and here price is making higher highs and higher lows. So it's as simple as that. The only thing that usually does confuse traders is if you take a look here, you can see that there is these micro swings. And when you have these micro swings, if price starts making lower lows and lower highs, a lot of traders starts thinking the trend is changing and now it's time to be bearish. But they're completely ignoring the overall context, and your overall context is your overall range. So you're still referencing your major swing. Your major swing is this swing low and this swing high. So unless this swing low is broken, you are still bullish. And you can always look to the left and reference the previous trend. And you can see price been bullish, and this was your change of character right here. So keep that in mind. Don't get tricked by these micro swings. And another trick here is, outside of looking at your swings and your trend, you could look at your daily swing forming. So you can see here, you would have a daily swing forming, and the easiest way to detect that is by an engulf. So you would have an complete engulf. And if you look to the left, you would have a volume gap right here where this needs to be rebalanced. One-sided, it was mostly sells, so you would expect this area to be filled up. And what you also have here is a engulf plus manipulation candle. So if you look really closely, you would see a manipulation candle. You would see that price took out this low prior to closing and completely overtaking this candle. So you would anticipate this next candle to be bullish, and you would expect bullish order flow until the next point of rejection, which would... But let's talk about operating the extremes. Operating in the extremes is referring to conducting business when price is oversold or overbought. The range extreme will be the top and bottom quarter of the range, which is also considered as the last zone of supply or demand before price reaches for external liquidity. When price breaks structure and escapes the range and then pulls back inside of the abandoned range, a new range is formed. The new range is the last swing low, which is the origin of the swing that initiated the break of structure, and the last swing high, which initiated price pulling back inside of the range. So now what you do is you split your range into 4, and now your top quarter is your extreme supply and your bottom quarter is your extreme demand. What do you have here? Once price comes back and closes inside of the range, what is your new range? Your new range is the swing high that initiated this break of structure. So the swing high that initiated this break of structure, and the swing low that originated the pullback inside of the previous abandoned range. What you want to do next is you want to pull out your fib, and you want to break the range into four. Why break the range into four? Because you are looking for your extreme zones. You're looking for your bottom quarter, looking for your extreme demand and your extreme supply. So trying to break the range into quarters to find the top quarter and the bottom quarter. So now that you have your extreme zones, which one are you specifically targeting? Like we said, always look to the left. You can see clearly that this is a lower low's been made and a lower high's been made, and you had a clear break of structure right here. A break of structure right here. So now instantly we are sellers. We're targeting this extreme right here. And what are we doing meanwhile? Nothing, because we're trying to be efficient and trade safely. And to do that, you need to sell high and buy low. And in this case, we are selling high. So here you sold at the top of the range and you exited your position at the bottom of the range. But it can get better. We can shrink the stop loss even more. So now let's talk about clean traffic. Here you have your extreme demand zone. Price rejects off that level and visits that level one more time. Price revisits that demand zone post the first interaction, and now that zone is much weaker due to the bulk of buys used for the initial contact. So now you can expect price to blow through that level, as that's the last barrier stopping price from breaking structure. So here's an example of clean traffic. So you have a used up demand zone. When price revisits that demand zone, now you have your overlap liquidity. So now price is incentivized to run through that level. So your clean traffic is truly in between these two levels of liquidity. So it's in between your first level of liquidity, which is your first interaction, and the external liquidity that's outside of the range. So here you have your extreme demand zone, and like we explained previously, you look to the left for context and you can see that you are a buyer. What you want to do next is go on the 1 hour time frame and look for your suppression slash your clean traffic. So you have your first contact and you have your clean traffic right here. You have this extreme rejection from this peak. So now if price gets above this level right here, you can get in an aggressive entry, or if you want to be a little bit more conservative and save a few points, you can get in a trade right above the entire zone. So price never went to that level. Let's see if we can find another one. And you have a rejection right here. So now you can get in an aggressive entry right here, or you can wait for a more of a conservative entry right above here. And your stop loss is your swing low, the bottom of your micro range. You would go zone to zone. So now let's go back on the daily time frame. And as far as your take profits, you would go zone to zone. So you pull out your fib. Your first TP would be your 50%. So actually, let's remove this. Oh yeah, and what I forgot to mention is your previous clean traffic right here. You can get in a second entry right above this level, but you can save this for another level. So your first TP would be right here. Your second TP would be right here. And your third TP would be external liquidity. So as you can see, so your first TP, you're looking at a 1-to-1. Second TP, you're looking at almost a 3-to-1. And your last TP, you're looking at a 4.5-to-1. And this is what this approach does. So actually the conclusion here is you're trading safely because you're buying low and selling high, you're looking for a confirmation and you're shrinking your stop loss. So even if you were just selling and buying at extreme levels, without the entry confirmation, without looking for a clean traffic, this would be your stop loss right here. And this is not the only way to trade extreme levels. As long as you're buying low and selling high, you should be fine. You could also use this entry where you could use your first interaction and wait for a sweep and wait for a return to origin as well. So there's multiple ways to trade this model. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you leave a comment. Let us know what lesson do you guys want next.